Is exports going to be some sort of knight in shining armor here, given that
I don't want to overstate the case. I mean, it must be said for the record that, between 2002 and 2010, that was the driver of growth. Exports grew at 15% per year for almost a decade. That drove the investment cycle, that drove growth. Consumption was a lagging indicator.
And I will never forget an interview with Jahangir Aziz, who said, we think of ourselves as special, but we're just another vanilla economy which grows when the world grows.
So that was a bit of hyper-globalization. And we actually had found that the elasticity of India's exports to global growth is still very strong. And it's particularly true because India's export basket has changed. There used to be a lot of gems and jewelry, leather, textiles. A lot of it is now engineering goods, capital goods, auto parts, pharmaceuticals. And those elasticities are actually higher to the global growth impulse. Now, underlying all of this, Ira, is a very different interpretation of the world. I mean, till 2 years ago, we were seeing secular stagnation, global growth at less than 3%. Where will that impetus come from? Right now, this is a new normal we're living in. Unprecedented fiscal and monetary stimulus from developed markets. And the fact is, over the next 2 years, we expect developed markets to grow at 5%, right, versus a 2% average pre-pandemic. And given the reopening and the vaccinations progressively in emerging markets, even they will grow above trend. So at least for the next 6 to 8 quarters, notwithstanding near-term concerns about the Delta variant, we're looking at global growth being much above trend. And that, all else equal, should provide a meaningful tailwind for India's exports. We're already seeing that. If you just look at manufacturing exports, they're almost 20% higher than pre-pandemic levels. Now, to be careful, a lot of this reflects higher commodity prices, steel, other commodities. If you deflate them out, even then, once deflated, manufacturing exports are growing in double digits. The growth has been almost 10% between January and June. So I think one clear tailwind can be exports growth. This is quite different from what people say, the IT industry will do well because the pandemic has accelerated technological adoption. That's a more secular story. I'm referring to a more cyclical story over the next 6 to 8 quarters, which should drive India's manufacturing exports.
So we should be able to get some upside from growth, even if one doesn't grow in terms of share of export. I haven't looked at the data, but I'm not sure if our various reports and committees in an attempt to raise our share in exports has worked or not. But even without that, we will see some upside.
That's right. This is purely cyclical. This is a rising tide lifting all boats. If in fact, our forecasts are right, that global growth is going to be above trend for the next 6 to 8 quarters, then just that should be, even if our share doesn't change, that should give us a lift in exports. I mean, part of this also, just to make this a little global, is this recognition by DM policymakers that there was possibly a policy error in 2010 when fiscal policy consolidated too quickly in the US and too quickly in the Eurozone, right? And in retrospect, that was seen as a mistake that choked the recovery. And therefore, you're seeing much more expansive fiscal policy in the US, in developed markets. That should lift global growth, and that should give emerging markets like India something to work with.
Just to stay with the global picture and detracting from the growth conversation for a bit. So we've seen commodity prices having risen. They've corrected a little bit in recent days. But net, given the upside that we could see from export and the downside we could see from higher commodity prices, how does that play out in net for us?
So two things here. I think that the most important price to look at is crude prices. So you're exactly right that to the extent that global demand is stronger, we should benefit from exports. But if crude is going to average $75 a barrel this year versus $45 a barrel last year, that's a 50% increase. That's a negative terms of trade shock, and that's going to hurt the economy no matter whether it's absorbed by the public sector through excise duty cuts, or it's absorbed by the private sector through higher inflation, margins getting squeezed for corporates. That is a risk we'll have to live with. The net impact is, if we get the kind of export growth that our elasticities suggest, the net impact from the global economy should still be positive. So that export growth over the next 6 to 8 quarters should offset the negative terms of trade shock from higher crude, and therefore the net impact is still positive.
And net exports is a significant contributor to GDP, just for...
Yes, I mean, to be fair, exports are about 20% of GDP. again, I don't want to overstate the case. We've made the case that both exports and public investment have to do the heavy lifting in the near term. Exports are 20% of GDP. One would argue the value add of exports is 2/3 of that. So the net impact is closer to maybe 13 or 15% of GDP. Public spending is probably 15%. So you're asking 30% of GDP to do the heavy lifting. But these have to serve as catalysts. If they serve as catalysts, you set in motion a series of events that causes utilization rates to go up, that begins to heal household balance sheets, that creates some employment impulses that can eventually trigger consumption and investment. So I keep saying exports and government and public investment have to be a bridge over the next 6 to 8 quarters before consumption, and giving time for consumption investment to recover.